So, good morning, all participants. Today we are having Professor S. Kevin for our first session. This is ninth session of this course. So, first session we are starting with Professor Kevin. He is going to talk about derivatives and its role in our portfolio management. Uh, he's having a very rich biodata. I will not highlight other things, but few things very important are he has been professor in Department of Commerce in Kerala University. Then right now he is emeritus professor for Kerala University. He has been pro vice chancellor of Kerala University since 2001, and he had been vice chancellor also for some period in Kerala University. He is having more than 40 papers in research journals, different national and international journals, and he has authored 5 books. And I have read one of his book, and that is brilliantly written, sir. It is very basic thing. If someone wants to start discussion or studying about portfolio management, I think your book is one of the best. I have read that security analysis and portfolio management. And another book I tried to buy, but I couldn't buy. That was derivatives. So when I contacted him, I requested him to speak on derivatives. So he agreed. Other than these two, he is having another book on investment analysis. He is having a book on financial management, international financial management. He is having a book on research methodology also. Sir, I request you now to start, take over from here, and you can deliberate. And sir, for your information, sir, our participants are not having access to audio and video. This is in webinar mode. So they will be putting their question in Q&A box or chat box. So towards end of the session, I will pose these questions to you.
Okay, right. I understand.
And request to the participants, keep on posting your paper questions. I have requested sir to elaborate all basic items of derivatives. So this topic may be little complicated initially, you feel. So doubt clearance is best. Pose questions. So if you ask questions, sir will certainly entertain that, sir. Now time is yours, sir.
Yeah. Thank you, Professor Bhartendra Singh, coordinator of the program, and thank you for the kind introductory words. And I will start. First of all, let me thank the university for giving me an opportunity for this session, because I saw the participants' name. I am speaking to a group of entirely unknown people, new people. Usually, I'm familiar with the participants here in Kerala and other places, but this is for me an experience where I have all participants which are attending for the first time, I think, my session. So thank you for giving the opportunity. I have a presentation, very simple presentation, because this derivative is a very multidimensional topic. So I have prepared an introductory presentation which will help you to understand the different dimensions of derivatives. Then you can ask questions, and then we'll be able to clarify that. So this is the plan of this session. As the professor said, I'll switch off my video and go to the presentation. Yes. Can you see the slide?
Yes, sir. Yes, sir.
Okay, fine.
Financial derivatives for risk management, yes.
Yes. And is it moving now?
Yes. Presentation now came. And
presentation.
yes, coming one moment. Yeah.
Right. Okay, fine. So this is our title, Financial Derivatives. And why are we using financial derivatives? We are using financial derivatives for risk management in investment. So we have to understand different things. We have to understand what is investment. We have to understand what is risk in investment. Then we have to understand how to manage the risk in investment with the help of, there are different ways of managing investment risk, but we are trying to understand one of the tools of risk management, which is the the financial derivatives. So this is our subject for today. Now, see, in the title, we have used three different words. First, we use the word investment, right? One second. Yes. First, we use the word investment. Another word used in the title is risk. The third word used in the investment is derivatives. So we are trying to understand three important words. First is investment, the risk in the investment, then how to manage the risk in investment with the help of derivatives. So this is the structure of our presentation. So let me start with the first term, investment. Investment, all of you are teachers, you are earning income. I'm sure that you will be making investments. So this is familiar to you. You are practitioners of investment. We are just trying to understand briefly what is this investment. Example, the best example everybody can think of is the bank fixed deposit. All of us are having bank fixed deposit or cooperative society fixed deposits. So it's an investment, no doubt about it. And some of you might be having shares. You would have purchased shares, you would have sold shares, you would have made profit there. So that's another type of investment. There are several types of investment instruments or avenues. I've just taken two: bank fixed deposit, shares of companies, shares of companies. Now, from these two examples, we can understand what is this investment? What do you mean by investment? That is what we are trying to understand. We do investment. All of us invest money in the bank or shares and other insurance products and so on. But what is this investment really? It is a commitment of funds. We have some savings with us. That savings we are giving to somebody else. We are committing our funds. We are parting with the funds. We are giving the funds to somebody else. It is a commitment of funds. All investments, if you keep the money in your house or in your shelf, it is not investment. It is savings. So investments means you have to part with the money. You have to give this money to somebody else, either the bank or the stock market. And this is a very important point. We are committing the funds for a future period. We are investing in the bank for 2 years, 3 years, 5 years, etc. We are buying the share and keeping it for 3 years, 5 years, or 6 months. So for a future period. And why are we doing that? Because we want to get a return. We want to create wealth. Investment is a method of creating wealth. So we want to create wealth. So we are earning income, we are spending income and saving some money, and we are trying to multiply that savings. That is called wealth creation. For multiplying that savings or increasing the amount of savings, we have to invest in places, in institutions, which will give you a return. So, but that return will come only in the future. So we are expecting a return. For an expected return, because each word is important here. Future period, expected return. We want a return. We are expecting a return, but we are not sure you will get that return. In the case of a bank, you are more or less sure. But even there, cooperative societies, supposing you are investing in cooperative societies, the cooperative societies may sometimes fail. You won't get the return. Or non-banking finance companies. You would have heard of non-banking finance companies. They're not banks, but they are other finance companies. They may fail, or they may not, they may default, they may not give the money back, or they may not give the return. When you buy a share, you are expecting a return. Definitely, you are expecting a return. I want a return of 15%, 20%. But you may not get that. It's an expected return. Because future is uncertain. This return will come in the future only. The return will not come immediately. The return will come only in the future. Future is uncertain. All of us know that. Future is uncertain. Therefore, there is uncertainty regarding the return that we might get in the future. So that uncertainty regarding the future return is what we call risk. So whenever we are making an investment, there will be an uncertainty. regarding the future return that you are going to get or the future return of the principal that you have invested. In some cases, almost 90% you are sure you will get it. But in some cases, 50-50. So in some cases, even less. So that uncertainty varies depending upon the instrument. A nationalized bank fixed deposit or is almost safe, no problem. But a cooperative fixed deposit may not be that safe. When you are buying shares, you are expecting a return. You are not sure you will get the return. So that aspect of uncertainty or possibility of not getting the expected return is what we call risk. So in investment, there is return and risk coming in the future. That return is expected return and it may not be materialized, and therefore there is a possibility of incurring a loss. So this is what is meant by investment. So in investment, there is always risk. Now, let us understand this concept of risk a little more. What is risk? I've already explained it, but still, the possibility of an unfavorable variation in the return, in the expected return. We are expecting a return in the future after 2 years, after 6 months, after 1 year. So in the future, we are expecting a return. But there may be a favorable variation as well as an unfavorable variation. You have purchased a share and you are expecting a return of 15%. You may get 20% return. That is a favorable variation. You may get only 5% return, which is an unfavorable variation. That possibility is there. It may not happen, but still, possibility is there. So that possibility of an unfavorable variation, not the favorable variation. The unfavorable variation in the future returns is really what is meant by risk. Or we can say the possibility of incurring a loss in the investment. So we have invested. Sometimes there may be a possibility. There's a possibility of incurring a loss. Sometimes that money may not come back. You may not get a return. You may even lose the money. The value of the share may, supposing you purchased a share, the value of the share may decline. So you are losing money. You are losing your investment. So there's a loss there. Possibility. It's all possibility, but still it may happen. So risk is the possibility of incurring a loss in investment. And it is inherent in risk, in investment. So in investment, there is always inherent within it the possibility of a loss. That is called risk. It is like, I sometimes give an example. It's like when you, during the daytime, when the sun is shining, you move out to the open ground. You are standing there. There will be a shadow. There will be a shadow. You cannot escape from the shadow. Wherever you go, you walk this side, that side. Wherever you walk, shadow will be there with you. It is part of it. It is part of your, during daytime when the sun is shining, when you're standing somewhere or moving somewhere, a shadow will be there. But the length of the shadow will vary depending upon the time and depending upon the position of the sun. If it is in the afternoon, the shadow will be very small. If it is morning and evening when the sun is on your left side or your front, then the shadow will be longer. But you cannot escape from the shadow. Shadow will be there, but sometimes it may be small, sometimes it may be big. In the same way, in investment, there is risk. You cannot escape from risk. But the risk may be less or more, like the shadow. But it is there. It is part of investment. So we want to make the risk less. Naturally, we want to make the risk less or reduce the risk or eliminate, minimize the risk. That is the intention of an investor. Okay, so we have understood the second concept, which is risk. It has to be managed by minimizing or avoiding. If possible, you can avoid. So minimizing, reducing, eliminating, avoiding that risk. We have to do that for our safety. That is called management of risk or risk management. The title, you remember the title, Financial Derivatives Risk Management Tool. So that risk management has to be done by an investor. And this process of managing the risk is technically called hedging. Hedging means it's a technical term used in finance. It means we are trying to reduce, minimize, avoid the risk in our investment. That process is called, risk management process is technically called hedging. You can say risk management, okay, fine, but technically we say hedging. So in investment, there is risk and the risk has to be hedged. Now comes derivatives, the third word. The third term in the title is derivatives. These are the hedging instruments. So just now I said we need to hedge the risk in investment. We need to reduce, minimize, avoid the risk in investment. And derivatives are the hedging instruments. So these are the derivatives are the instruments which can be used for hedging risk. So we say derivatives are hedging instruments. It's a general statement. So then we have to understand what you mean by derivatives, how these derivatives are hedging or reducing the risk and so on. Those are the things that we have to understand when we are studying the subject. The first statement is derivatives are hedging instruments. They are used for minimizing the risk in investment. How that is done, we will see. Now, there are two types of derivatives. One is commodity, the other is financial derivatives. So if you are trying to reduce the risk in commodity, then we say commodity derivatives. If you are trying to reduce the risk in financial assets like shares, bank deposits, mutual funds. So if you are trying to reduce the risk in financial derivatives, we call it financial assets, we call it financial derivatives. If you are trying to reduce the risk in commodity trading, say gold, for example, gold prices are changing. Sometimes it goes up, sometimes it comes down. So there is a risk in if you buy gold, gold is an investment. You can buy gold coins and keep it with you. After some time, gold prices are expected. We are expecting the gold prices to increase, but it may not happen. Sometimes gold price will decline. You will lose money. So there is always the possibility of incurring a loss in a commodity investment. Commodities can also be used for investment. So if you are trying to hedge the risk in a commodity, then we call it commodity derivatives. If you are trying to reduce the risk in financial assets, we call it financial derivatives. And that's what I'm explaining here. You can read it. Commodity derivatives are used for hedging the risk in commodity trading. So commodity trading, the risk can be reduced with the help of commodity derivatives. Financial derivatives are used for hedging the risk in investment. In investment like shares, mutual funds, ETF, etc. Okay. So this session, we are trying to understand what these derivatives are. We have started with the introduction saying that derivatives are hedging instruments. They can be used for reducing, minimizing, hedging the risk. Okay, now we are moving into an understanding of derivatives. Once again, can the participants see the slides, sir?
Yes, sir. Yes, sir.
They can see the slides.
Yes,
Okay.
yes, sir.
Right. Thank you. So we are going to make some introductory remarks before moving into a detailed or understanding of derivatives. Introductory remarks. Let us see. These financial innovations of recent origin. These derivatives are financial innovations. They are new things, innovations, financial innovations of recent origin. So when I was a student, it was not there 40 years back. We did not study these things because it was not there. So this started only during 1990s, 1995 in the world. In India, it came only by 2000. So you see, they are very new, very recent. Whereas the stock market shares were very old. So these are of recent origins. These are innovations. We will see that. These were discovered for a particular purpose. The purpose was to minimize the risk or manage the risk in investment, because in investment, risk was there from the beginning, but nobody knew how to manage the risk. So this risk management tools were invented recently. So that is why we say they are financial innovations of recent origin. And this derivatives trading is an important economic activity globally now. Even though it is new, derivatives trading is now an important economic activity globally, all over the world. All over the world. That is the situation now. See, that is the situation. Within a short period, it has become an important economic activity. So you can understand the importance of this. Very important activity. It became popular only during the second half of the 20th century. That is what I said. In the world, it became popular only during the second half of the 20th century. In India, it became popular only during the 21st century, beginning of the 21st century. Now, it is set to dominate the commodity and financial market soon. Very soon, commodity derivatives trading will be the most prominent activity in the commodity and financial markets. That is the way it is heading. I'm just trying to show you the importance of derivatives. What we are now trying to understand is two things: understanding of the basic concepts of derivatives and the practice of derivatives trading for risk management. So this is what we are trying to understand. Okay. Now, to understand this derivatives, I thought it was better to take a few situations, interesting situations, so that you will understand it better. Let us take a few interesting situations. First one, an investor. All of you are investors, I know. So an investor, let's take an investor. He has some money with him. He wants to buy the shares. He anticipates a decline in share price held by him. So he has already purchased some shares, holding some shares. Most of you would be having that. So we are having some shares. We purchase the shares, or we are holding the shares. The share prices are okay. But now we are anticipating a decline in the prices of shares held by him. Supposing you are holding ICICI shares, or TCS shares, or Wipro shares, or SBI shares. The share price is, the SBI share price is around yesterday it was around 420. So we may be anticipating a decline. So the investor is afraid now. He is having some shares. It has a value. He is anticipating that the share prices may decline. That means he is going to suffer a loss in the future. What to do? Can he do anything? That is the question. See, if the share price, supposing a share is 320 rupees, a share is 320 rupees now, 320. He is anticipating that the share, something happened in the company like Adani. You would have read about Adani's shares, no? So anything can happen. So something happened in that particular company's shares. So share price is is anticipated to decline. So from 320 today, we are anticipating that the share price may become 250 or 220. 100 rupees decline may be there. It may happen. What to do? Can you do anything about it? So you may have to sell the shares at the shares which you purchased at 320, you may have to sell at 220. There is a possibility of incurring a loss. What to do? Can you do anything about it? That is the question. Can you avoid this risk? There is a risk there. Possibility of incurring loss. What to do? Let's take a mutual fund. A mutual fund, a mutual fund is announcing a scheme, and the mutual fund gives 1 month's time. So it is collecting money from people, and then the large amount which is collected from different people will be invested in the stock market to purchase the shares. When the share prices are increasing, they make a profit, and this profit will be divided among the mutual fund holders. So this is what the mutual fund is doing. Most of you commerce students, commerce teachers would be familiar with it. Management teachers would also be familiar with it. A mutual fund is an organization which is collecting money from individuals, small amounts and large amounts of money. When they get a big sum, crores of rupees, this will be invested in the share market in different shares. They will create a portfolio and then they will wait for 2 years, 3 years, 4 years. So slowly the share prices will increase and then they will sell it and the profit will be distributed to the shareholders. Okay. A mutual fund has announced a new scheme and people are contributing to it. So they are expecting to receive the money after 1 month. So only 1 month's time is there. So by the end of the month, the whole money will be collected from different people and then they will invest the money in the stock market. Now they are anticipating, or the mutual fund is anticipating, an increase in the share prices. So during this 1 month, they are anticipating that there will be an increase in the share prices as a whole. Most of the different shares, the prices will increase because of good economic development. So by the time the money is ready, they will have to buy the shares at a higher price. Today, the prices are low, but today they don't have the money. After 1 month, they receive the money. By the time, share prices will increase. So they will have to buy the shares at a higher price. So naturally, that is a loss because they could have purchased the shares at a lower price today if they had the money, but they don't have the money today. So can they do anything about it? What to do? See, in this situation, what can they do? Can they do anything to avoid this loss? So that is the question. This is the question. Another situation, an exporter. In India, now we have a lot of people exporting, importing. Let's take the case of an exporter. He has exported goods to USA, let us say, and you will not get the export proceedings immediately because the goods have to reach there, they have to be inspected, and they have to be found satisfactory. Only after all these procedures, the importer in USA will send the money to the Indian exporter. So he is expecting to receive the export sale proceeds in US dollars. The sale proceeds will come in US dollars after 1 month. This is a situation faced by all exporters. A real situation, very dangerous situation. See, he has already exported goods. He is expecting to receive, say, $50,000 or $1 lakh after 1 month. Now, dollar cannot be used in India as such for buying goods. You have to convert the dollar into Indian rupees and then only you can use it. So when he receives the US dollars, he has to convert it into Indian rupees. What is the conversion rate or exchange rate? We call it the exchange rate. So after 1 month, what will be the exchange rate? Nobody knows. That's a big problem. Today, let us say, he is anticipating a decline in the dollar prices. Today, the dollar is, say, 80 rupees or 70 rupees. But after 1 month, it may be only 65 rupees. We don't know. It may be more. That is a favorable variation. So today, there is a dollar price. There is an exchange rate. But after 1 month, when he is receiving the dollars and ready to convert it into Indian rupees, the exchange rate at that time may be favorable or unfavorable. But we cannot predict. So he cannot take a risk. He cannot hope for a favorable exchange rate. The exchange rate may decline. From 70 rupees today, it may become 65 rupees. Or from 80 rupees today, it may become 75 rupees. So then he will be able to convert it only at 75 rupees. He will suffer a loss of 5 rupees per dollar. A big loss. See, this is a very, very embarrassing situation, very real situation for the exporter. What to do? See, so all these people are facing risk. Okay, so they want a solution. We have seen 3 people here. Who are the 3 people here we have seen? One is an investor who is anticipating a decline in the prices which he holds. A mutual fund who wants to buy the shares from the market, but they are anticipating an increase in the share prices. Then we have an exporter who is expecting to receive US dollars after 1 month. So the exchange rate after 1 month may decline. So all these people want a solution. There is a simple solution. I think you would have guessed it by now. The solution is derivatives. So derivatives provide the solutions in all these cases. So wherever there is risk, derivatives will provide the solution. That is why we said derivatives are hedging instruments. Now let us say what are derivatives and how they are able to hedge the risk. Question, what are derivatives? These are the instruments traded in financial markets. So these are financial instruments, naturally, financial instruments traded in the financial markets. So derivatives are also, just like shares, derivatives are also instruments traded in financial markets. Now, we are going to use a derivative to hedge the risk in a particular commodity. For example, a share or US dollar. The exporter is going to convert US dollars. So he is facing a risk in the US dollar. In all these cases, in the case of a share, mutual fund and investor, they are going to invest in shares. Exporter is going to receive dollars, that is foreign exchange, foreign currency. So they are dealing with the different types of assets. Investor is dealing with shares, mutual fund is dealing with shares, their assets. The exporter is dealing with the foreign currency. Now, the peculiarity of this, all these assets are, their prices are varying, fluctuating. That is the problem. Say, for example, in the case of the exporter, is going to receive US dollars after 1 month. Supposing the US dollar exchange rate is fixed at 70 rupees. Supposing the exchange rate is fixed at 70 rupees. There is no problem. After 1 month also it will be 70. Today also it is 70. After 1 month it will be 70. After 2 months it will be 70. There is no risk there. He is not facing any risk. So he is facing a risk because the price of the asset is fluctuating. Investor, say mutual fund, take this mutual fund. Take the mutual fund. Mutual fund, they are going to buy shares. They are anticipating an increase in the share price. Supposing the share prices are fixed. SBI share is fixed. ICICI share, the price is fixed. So he has no risk there. After 1 month, he can buy the shares only after 1 month because he will receive the money only after 1 month. So after 1 month also the share price will be the same because it is fixed. He can buy it. No problem. No problem. So the problem arises because the prices are fluctuating. Say, supposing you want to buy a mobile. All of us are now buying different types of mobiles. So you want to buy a mobile. Is there any risk there? There is no risk. You can buy the mobile anytime you want. You can buy it next month. You can buy it after 2 months. Supposing a mobile has come. So you don't have the money now to buy it. You are expecting some money next month. So you can buy it next month, no problem. Because the price of the mobile is fixed. Price of the mobile is fixed. So you don't face a risk there. So in this case of shares and foreign currency, they are facing a risk because the prices are fluctuating. So that is the problem. Risk arises only in the case of assets where prices are fluctuating. You don't need a derivative for buying a mobile. You don't need a derivative to buy a mobile. I have, as the professor was mentioning, I have about 5-6 books. They are all published by Prentice Hall of India, New Delhi. So they are fixing the price. I am not fixing the price. And they are selling it, marketing it. The price is fixed till the next edition. Till the next edition comes, the price is fixed. So there is no, supposing students and teachers, they want to buy the book. They don't need a derivative. There is no risk there in buying that book. But the price is fixed for the next 3 years. Next 3-4 years, the price is fixed. So you can buy it anytime. There is no risk involved. You don't need a derivative to hedge the risk there. I hope you have understood the situation. So the problem comes because the prices are fluctuating. So let us see here. See, Derivatives are instruments traded in financial market. These instruments are linked to some other financial security or asset like equity shares, commodity like gold, currency, etc. So we are going to use a derivative to hedge the risk in a particular asset. So this derivative will be linked to an asset whose prices are fluctuating. So always derivative does not stand alone. Derivative is used for hedging the risk in an asset. Therefore, always the derivative is linked to some other asset. It may be linked to, if you are trying to hedge the risk in shares, so the derivative is linked to the shares. If the exporter is trying to hedge the risk in the currency, that derivative is linked to currency. So that asset, the linked asset, is called an underlying asset. Instruments used for hedging the risk in the linked asset. That linked asset is called underlying asset. So derivatives will always have an underlying asset. That is, they will be linked to an asset whose prices are fluctuating. So we are going to use the derivative to hedge the risk there. So these are derivatives are simply, we can say, derivatives are instruments used for hedging the risk in the linked asset. That is why we call derivatives are hedging instruments. That linked asset is called underlying asset. What I'm trying to explain are the basic concepts regarding derivatives. Now, later on, we will see how the derivatives are working. Now, I'm trying to explain the technical terms and the concepts in derivatives. So, we have a concept of underlying asset. What is risk and hedging? Because derivatives are hedging instruments. Hedging means reducing risk. So what is risk and what is hedging? We have already seen that risk is the possibility of incurring a loss. And why does the risk arises? That is what I was trying to explain with so many examples. Risk arises in cases of uncertainty regarding future prices of assets. Read the sentence very carefully. Risk arises in cases of uncertainty. Regarding what? Regarding the future prices. What will be the dollar price after 1 month? What will be the share price after 1 month? There is an uncertainty. Not about the present price. The uncertainty is about the future price. Uncertainty regarding the future price of assets. There is a price fluctuation. Example, share prices. What will be the future share prices? We do not know. What will be the commodity prices, gold prices in the future? We do not know. What will be the interest rates in the future? We do not know. What will be the exchange rates in the future? We do not know. So we are facing another risk. So what we want here is, we want to fix the future prices. See here, we want to fix the future prices. The future prices at present is uncertain. Therefore, we are facing a risk. So to remove the risk is very simple. We want to fix the future price. The exporter wants to sell US dollars after 1 month at a fixed price. He will fix the price today. He will fix the price today for the future transaction. He will fix the price today for the future transaction. Because if he is waiting for the future, in the future, what will be the price? We do not know. Because of that uncertainty, using a derivative, we are going to fix a price for our future transaction. That is all. Derivatives are very simple. The idea behind derivatives, the concept behind derivatives is very simple. In the future, there is uncertainty. We want to remove that uncertainty. For that, we are going to we have a transaction in the future. Say, the exporter. Exporter will have a transaction in the future. He will be converting the US dollars into Indian rupees. So he will have a future transaction. The price for that future transaction, he will fix it today. That using a derivative. That's all. So derivative is a method of fixing the future price of a future transaction. I hope you are following me. Okay, actually, derivatives is actually it is not complex. It is unfamiliar. We are not familiar with it. Therefore, we think it is complex. Actually, it is very simple. This is all. What the derivative is doing is a person who has a future transaction. We will use a derivative to fix the future price of the future transaction. How it is done, we will see. Okay. The interested parties like the exporter, mutual fund, investors. So the interested parties would like to eliminate or at least reduce the risk involved. That is called hedging the risk. So risk is the possibility of incurring a loss. Hedging means reducing, eliminating the loss. Or the loss arises because, or risk arises because of uncertainty in the future prices. So we are removing that uncertainty by fixing a price for the future transaction. That's all. Very, very simple. Derivatives are hedging instruments, or we say risk management tools. Two terms, hedging instruments or risk management tools. Okay, so now let us look at which are the assets that need hedging. Very simple. You will be able to answer that one. A mobile does not need hedging. A book does not need hedging. See, because the price of the book does not change. The price of the book in the future is certain. It is not uncertain. The price of the book in the future is certain, not uncertain. The price of the mobile after 2 months or 3 months is certain. It's not uncertain. It's already fixed. So, which are the assets that need hedging? Hedging is needed by assets whose prices are fluctuating. Whose prices are fluctuating. So, there are two types of assets. Assets which need hedging, assets which do not need hedging. Assets which need hedging are having price fluctuation. Assets which do not need hedging are having fixed prices. So let us look at assets that need hedging. Naturally, equity shares. Share prices are changing. Currencies, foreign currencies, US dollar, euro, Japanese yen. Exporters and importers are using these currencies. The prices are fluctuating. So they have to use derivatives. Commodities like gold, rubber, oil, prices are changing. So they need hedging. If you take loan or you want to take loan, the price of the loan is the interest rate. The interest rates keeps on changing every 2 months or 3 months. So, okay, we leave it loans, but try to look at the other three. Shares, currencies, commodities. So see, these are the assets that need hedging. Okay, so derivative instruments have been created. See, created. They have been created about 30, 40 years back. They were not there earlier. So derivative instruments have been created through financial engineering. We say financial engineering for hedging the risk in these assets. Now, what are these derivatives? Because I have been using the word derivatives, not singular. I have been using the word plural, derivatives. So what are these derivative instruments which can be used for hedging the risk? There are four basic types of derivatives. Basic types. There are other combinations of this, but the four basic types of derivative instruments are forwards, futures, options, swaps. Swaps are not very, very popular or very important. They are a very small instrument, but the three most important instruments are forwards, futures, options. You can use any of them. They're all similar, more or less similar, with some differences. So the three instruments, forwards, futures, and options, are more or less similar. They are just doing one thing. They are fixing the price of a future transaction, and their functioning is slightly different. We will see that. That is all. Otherwise, they are doing the same function. Let's take forwards first. Once you understand forward, it is easy to understand the other two. And it is very easy to understand forward. Very easy to understand forward. In fact, there is nothing new there. The forward contracts are part of our everyday life. So that is why I said this derivatives are not complex. We are familiar with it. For example, supposing you want to buy a luxury car, not the ordinary car, which is costing 4 or 5 lakhs, a luxury car costing lakhs of rupees or crores of rupees. You want to buy a luxury car. You want to buy a luxury car. Supposing, let us take with the example of a book. You want to buy a book. What do? You go to a shop, bookstore, give the money, take the book. That's all finished. Buying means buying and selling. Bookseller is selling the book, you are buying the book, you pay the money, he gives the book. So you pay the money, he gives the asset. Just one step, that's all. Supposing you want to buy a luxury car, you go to a car dealer. The car will not be ready there. The book is ready in your bookstore. Books are ready in the bookstore. This car, luxury car will not be available there. The ordinary car may be available there. The ordinary car, the Maruti or Honda and so on, they may be available in the showroom itself. You can buy. But if you want to buy a luxury car, you go to a showroom, it will not be available there. They will show you pictures because they don't keep it ready because very few people buy them. So what we do is, okay, you see the pictures and you select one and then you say, okay, we'll make an agreement. So there's an agreement is signed. An agreement is signed between the dealer and you. That is within 3 months, the dealer will say, I require 3 months. So by the time I will contact the company, manufacturing company and get the car ready. So they will sign a contract. That is the dealer is saying that within 3 months I will give you the car. You are saying that when the car is ready, within 3 months I will pay you the money. And now you pay an advance. So you pay an advance, sign an agreement, you go home. After 3 months, when the dealer calls you, the car is ready, you come and pay the balance and take the car. So there are two stages here. First is the agreement stage, second is the actual execution. That agreement, what you are doing there, you are agreeing to buy an asset in the future. So the transaction is a future transaction. You will fix the price in the agreement naturally. Most important part is in the agreement, you will say that I want this type of a car. The price is fixed. Both the dealer and the buyer agrees upon a price. The price is fixed for a future transaction. So for a future transaction, the price is fixed through an agreement. Very simple. We are all familiar with the agreements. This is a forward contract. This is a forward contract. I told you earlier, what are we doing? In a derivative, what we do is we are fixing a price for a future transaction. Another example. All of you would have purchased land and built houses. How do you buy land? We don't go to the sub-registrar's office and sign. Both the buyer and the seller does not go to the sub-registrar's office and sign the documents in the first stage. First, the owner of the land and the person who is intending to buy the land, they will talk about it. They will see the land. They will talk about the price. They will see the documents. And first of all, they will agree on a price. That is the most important point. Both the buyer of the land and the seller of the land will agree upon a price and a time, 3 months time, usually 2-3 months. And they will sign an agreement. All of you are familiar with that. We buy a land. First you sign on 100 rupees stamp paper, we sign an agreement that we will buy this land within 3 months. So many acres of land. The price per cent is fixed there. Price is fixed. Transaction is going to happen only in the future. So the price for a future transaction is fixed. That is derivative. So examples: luxury car, real estate. So we are all familiar with the forward. There's nothing to learn there actually. I hope you are following me. There's nothing to learn new. So let us define a derivative. From this example, we can define a derivative. What is a derivative? It's an agreement. That's the most important point. It's an agreement. Derivative is an agreement between two parties. To do what? To buy or sell. One party agrees to buy, the other party agrees to sell what? An asset. It may be a luxury car. It may be a real estate. It may be a commodity like gold. It may be a share. It may be dollars. The exporter will agree to sell US dollars. He's going to get US dollars after 1 month. So an exporter will sign an agreement to sell an asset, US dollars, at a predetermined price. The price is fixed. That is the most important. The fourth point is the most important point. Price is fixed, US dollar. I am agreeing to sell US dollars after within a specified future date, within the next 3 months. I am agreeing to sell US dollars at 70 rupees. He is fixing the price for the future transaction. Simple derivative is an agreement to fix the future price of a future transaction. See, this definition, all of you can understand. Very, very simple. It's an agreement to buy, and the other party sells an asset. The asset may be anything. And this asset has a peculiarity. The asset, the price is fluctuating. The asset price is fluctuating. Therefore, we are using an agreement to fix the future price at a predetermined price within a specified future date. Okay. I am sure you would have understood by now what is meant by forward. Derivatives in general, forward. It's an agreement between two parties here. The agreement is between two parties, the buyer and the seller. It's a contract for future, forward delivery. We are not going to buy the asset or sell the asset immediately. Not ready. It's not ready. The car is not ready. Dollar is not ready. Exporter, he does not have the dollar now. He will have the dollar only after 1 month. So it is a contract for future. It's a future transaction. We are dealing with a future transaction. We are fixing the price of a future transaction. It's not a ready transaction, future transaction. Okay. Let's take an example so that you can understand very clearly what an exporter is going to do. Let's see what we have seen. What is a forward definition we have seen. Now how it will be carried out by an exporter or importer, we are going to see. Currency forward. We call it a currency forward because the underlying asset is a currency. You know the word now. The word is familiar to you now. Currency, underlying asset. The underlying asset is currency. So we call it a currency forward. Let us take it will the exchange rate fluctuations. Exchange rates are fluctuating every day. It will expose the exporters and importers to considerable risk. Exporters and importers are facing risk because the exchange rates are fluctuating. So forwards can be used for hedging the risk in foreign currency dealings. You can use forwards, you can use futures, you can use options. All the three can be used. We are now understanding forwards. Once you have understood forwards, it is easy to understand what is this futures and options. Okay. The forwards are derivatives traded over the counter. So the buyer and the seller say, let's take the exporter. Exporter will buy or sell the foreign currency which he receives. He will sell to a bank or a foreign exchange dealer. There are foreign exchange dealers out there. So either the exporter can sell it to a foreign exchange dealer or he can sell it to a bank. So the agreement has to be made with the foreign exchange dealer or with the bank. So the exporter will go to the bank's office or the exporter will go to the foreign exchange dealer's office, sit on one side of the table. The exporter sits on one side of the table. The foreign exchange dealer or the bank manager sits on the other side of the table. So across the table, they are signing an agreement. So it is called OTC, over the counter. Over the counter. So the agreement is signed between two parties. Only two parties are involved. Nobody else is involved. Government is not involved. Stock market is not involved. Reserve Bank is not involved. Nobody else is involved. The buyer and the seller only are involved. They are sitting on a table, on two sides of the table, and signing an agreement. It is therefore called OTC, over the counter. So forwards are OTC derivatives, over the counter. It's a private agreement. In other words, all derivatives are agreements. All derivatives are agreements. This is a private agreement between two parties, signed over the counter. Okay. Let's take an exporter. Forward dealings in foreign currency. An exporter. What will an exporter do? Now all the exporters are doing it. So because they know this. Exporters and importers, they know. They are more familiar with than us. We are only studying the theory. They are actually doing it. So there are several research going on. And we find that when you do a research, analytical research, we find that they are very, very familiar, they're very comfortable. We were trying to find out which of the three instruments they are using, whether they are using forwards or futures or options. So research is going on regarding that, which is the preferred instrument, whether it is forwards or futures or options. So we will see how an exporter can use a forward contract to hedge the risk. Read it and let us try to understand this example. An exporter exports goods worth US dollars 1 lakh to USA. So he has already sent the goods. The bill is ready. Bill is also sent. The bill shows an amount of 1 lakh US dollars. So that person in USA or the company in USA will pay to the exporter, Indian exporter, 1 lakh US dollars after, not now. The receipt of US dollars expected after 3 months. So after 1 month, 2 months, or 3 months. Because there are so many formalities. So money has not come. It will come after 3 months. And that is the problem. After 3 months, what will be the exchange rate? It is fluctuating. What will be the exchange rate of US dollar? Today it may be 70 or 80, but in future we do not know what will be the. Let us take the current exchange rate is 72.50. This slide was prepared sometime earlier. Today it is around 82. US dollar is 82.50, 82, 83 and so on. Let us take, we want to understand the concept. Current exchange rate is 1 US dollar is 72.50 today. But after 3 months, what will be the rate? Because the exporter can sell the US dollars only after 3 months and the rate prevailing at that time. That rate we do not know. It may be 70 or 69. It may be more than this. Then he is lucky. I would say he is lucky. But he cannot wait for that luck. No exporter will wait for the luck. Most likely he'll be unlucky. So the exchange rate may be less than 72.50. It may be 70, 69 and so on. So see, he is anticipating a decline in the value of the US dollar is anticipated. Now he is facing a risk. He wants to eliminate, reduce, hedge the risk. He can use a derivative. That means very simple. He has to sign an agreement, that's all. Go to a bank or go to a foreign exchange dealer and sign an agreement with them that, okay, I am willing to sell you 1 lakh US dollars within 3 months. At the rate has to be fixed by the two parties. Very simple, just a matter of 5 minutes. So in 5 minutes time, you can reduce your risk. In a matter of 5 minutes, you can reduce your risk by signing an agreement with a foreign exchange dealer or a bank. That is called a currency forward. See, exporter enters into a forward contract to sell US dollars after 3 months or within 3 months at 72. Okay, both of them agree upon 72 per US dollar. Now we can go peacefully, go home. After 3 months, when the dollar is coming to his bank account, he can come and say, okay, my dollar is ready. Convert it at 72 rupees. At that time, the dollar may be only 69. Whatever be the rate, he can, because it's an agreement, he can sell the US dollars at 72. He has eliminated his risk. So, understood? Very simple. Now, let us look at the future situation. After 3 months, when he has received the US dollars and he is converting at 72 rupees, but then what is the actual market rate? He can convert at 72, no doubt about it. It's only again a matter of 2-3 minutes. But in the market, what is the rate? Let us look at it. After 3 months, the rate in the market may be 70. At that time, after 3 months, the rate in the market may be, so he'll be happy because he can convert at 72. See, he can convert to 72 because of the agreement. So he's gaining, let us say he's gaining 2 lakhs. Or it may be 72. The market rate at that time may be 72. That means he's also able to convert to 72. There is no profit, no loss. Or it may be 73. In the market, the rate may be 73, but he has to convert at 72 because it is an agreement. So he may feel bad now. He may feel bad because if I did not sign the agreement, I could have sold at 73. That's only an opportunity loss. We say opportunity loss. It's not he's not losing any money. He's able to sell it at 72 rupees. It's an opportunity loss. He could have made a profit there. We call it an opportunity loss. Okay, so let's take an importer. What he will do, let us see. Forward dealings in foreign currency. An importer is a person who has imported something, say machinery, for example, from Europe or USA or Japan. He has to make a payment in the foreign currency of that country. So he has to buy the foreign currency from the Reserve Bank of India or a bank or a foreign exchange dealer. He has to buy the currency and give it to the person from whom or the company from whom he has purchased the machinery. An importer has imported goods worth euro. Let us take another currency. 1 lakh euro from Europe. He has imported goods, machinery from Europe. The bill is 1 lakh euro. He has to pay 1 lakh euro, not immediately. Payment has to be made very slowly, only after 3 months. So after 3 months, he will have to buy euro from a foreign exchange dealer and give it to the person in Europe. Supposing euro today is 80 rupees. After 3 months, the euro may become 85. Then he will have to buy euro at 85 rupees. Today he could have bought euro at 80 rupees. But after 3 months, you do not know what is the amount. It may be more than this today's rate. Then he will suffer a loss. If it is less than today's rate, he'll be happy, no problem. But we cannot be sure. So this importer will be unhappy if the exchange rate in the future is more than today's exchange rate because he will have to buy euro at a higher price. Current exchange rate, let us say 82 rupees. Today's exchange rate. In future, if it is 85, he will suffer a loss. If it is 80, he is happy. But we cannot be sure. So it is better to fix a rate for the future transaction today itself. It is always better to fix the rate of the euro for the future transaction. That is what a derivative is doing. Increase in the value of the euro is anticipated. Therefore, he will enter into a forward contract to buy euro after 3 months or within 3 months at 82.50 per euro. Price is fixed. He need not worry. Uncertainty is removed. For him, in the market, there will be uncertainty, fluctuation. But for this particular person, importer, there is no uncertainty because he has already entered into an agreement to buy euro at 82.50. So after 3 months, when he is ready to make the payment, go to the bank, go to the foreign exchange dealer, buy the euro at 82.50. Whatever be the rate in the market at that time, the rate may be 84. So if the rate is 84, he is happy because he can buy at 82.50. If the rate is 82.50, there's no profit and no loss. But if the rate is 81.50, he has to buy at 82.50 because of the agreement. So we say there is an opportunity loss. Okay, now you have understood one derivative instrument, which is forward. It is simply an agreement fixing the price of a future transaction. So let us describe the operation of a derivative. It is facilitating the exchange of financial assets like currencies or shares in the future at prices determined in the present. So the transaction is going to happen only in the future, but the price for the future transaction is fixed now. That is what the derivative is doing. Or we can say it enables the participants to lock in a price for the future transaction. For the future transaction, we are locking in a price. That is what the derivative is doing. And therefore, once you lock in a price, once you fix a price, uncertainty is removed. Uncertainty arising out of future fluctuations in the asset prices is eliminated. Example, we have seen that an exporter can convert foreign currency into Indian rupees in the future at a predetermined price. This is what a derivative is doing. This is what forward is doing. I hope you have understood. Doubts you can clear later. I will, let me just explain briefly what is futures and options. Then we can move to question answer sessions. Okay. Futures. Now, once you've understood this, now it is easy because futures is the same as forwards. It's also an agreement to buy or sell an asset at a predetermined price within a specified future date. It's an agreement fixing a price for the future transaction, just like the forward. Then you may ask a question or doubt, then what is the difference? Is there at all a difference between forwards and futures? There is a difference. See, these futures are traded in organized exchanges. It is not, the agreement is not signed between two parties across a table. The agreement is transacted in the stock exchange. So we can use the website of the stock exchange. You have an account, you should have an account. So you can open the website. You give a buy order. You want to buy or you want to sell. The exporter, for example, in the earlier case, the exporter wants to sell 1 lakh US dollars. So he will give a sell order there. So you can give how many, what is the quantity you want to sell, what is the price you want to sell at, what is the time within which you can. So 3 things you have to give. So you give a sell order. So this sell order is seen by all the people in the country, not only in India, anywhere in the world, because NSE is now open to the whole world. So your sell order is seen by people all over the world. Somebody who likes that, who likes to buy from you, you are prepared to sell US dollars, 1 lakh US dollars, let's say 72.50 within 3 months. So you are giving that order. Your intention you are showing there. So somebody somewhere in the world, somewhere in India, somewhere in the world likes this, he will click on that. That means he is agreeing to buy. Okay, finished. So you have agreed to sell, the other person has agreed to buy. Somebody in India. But we don't know who that person is. It doesn't matter because for us it is the clearing house. So the clearing house will, we can sell to the clearing house. Once somebody has agreed, the software will know who is the buyer and the seller. So everything is done by the software. So the NSE software knows who is the seller and the buyer. As far as I am concerned, the buyer is the clearing house. Clearing house will buy the dollars from me and give me Indian rupees. The other person will give Indian rupees to the clearing house and the dollar will be given by the clearing house to the other party. But we do not know who that party is. So again, very simple. It's again matter of 5 minutes. It won't even take 5 minutes. You give the order there, and because it is a global market, everybody is seeing it. Somebody will click immediately. A matter of seconds, your order is over, finished. So the difference is this. The other is a bilateral agreement. Forwards is a private bilateral agreement. You are going to an office and signing. There are only 2 parties are involved. Nobody else is involved. This is futures is the same thing. It's an agreement, but it is transacted through the exchange. NSE, BSE, separate exchanges also are there. Futures exchanges. So that means there is no default to there. Clearinghouse is our counterparty. So very safe, very quick. So that is the futures. There are different categories of futures like commodity futures where you can buy or sell agriculture commodities, precious metals. Currency futures are there. You can buy and sell foreign currency. Index futures are there. You can buy and sell stock indices. Stock futures are there where you can buy and sell shares. Stock futures as a hedging tool. Okay. Let's take, let me just give you one more example. Stock futures as a hedging tool. Stock futures. What is a future? It's an agreement. Stock future is an agreement to buy or sell a stock, a share, in the future at a fixed price. So future simply means an agreement to buy an asset. Here the asset is the share of a company. So we are fixing a price for a future transaction. So I want to buy shares in the future. In the future, the share price may vary. So I'm fixing a price for the future transaction. That's all, very simple. Well, let's just take an example. See, an investor is expecting to receive some money for investment in a share. Say if you are employed, you are going to get some salary arrears, let us say, or DA arrears, salary arrears, DA arrears. So an investor is expecting to receive some money for investment in a share. So he is planning to invest this share. Anyway, it is arrears. So I want to invest this money in the stock market and create some wealth. Fine, good. He is expecting to receive. He has not yet received. He will receive the money only in the future. So he can buy the shares only in the future. But what is he anticipating? A rise in the share prices is anticipated. So he is expecting to receive the arrears in 2 months. And he wants to invest the money in the stock market. Good. But by the time, after 2 months, what is the anticipation? The share prices are going to increase. So he will have to buy the shares at a higher price. At a higher price. So there is a loss. Possibility of a loss. So he's going to have a future transaction. Remember, he is going to have a future transaction. He is going to buy shares in the future. So now he is going to fix the price for the future transaction. He is going to fix the price for the future transaction. The price of the share for the future transaction. He is not going to buy now. He will be buying only in the future, but he is going to fix the price for that future transaction now through an agreement. And that is called derivative. Derivative is that agreement. That agreement of fixing the future price transaction is a derivative. Here he is going to use futures. That means this agreement will be signed not between two private parties, but in the stock market. In the stock market with an unknown party. We are going to sign the agreement. So I am going to sign an agreement to buy the share at a fixed price, say SBI share. I am fixing the price for the future transaction. To buy the share. So somebody else will agree to sell the share to me at this price. But who is that other party? I do not know. But for me, clearinghouse will give me the share. He can buy stock futures at around the current price of the share. So he will buy a stock future through the exchange. That is the only difference between forwards and futures. So in future, even if the price of the share has increased, he can buy the share at a predetermined price. SBI share price may become 500, but he can buy the share at the price which has already agreed. That is important. So you can see it is derivatives is a very simple agreement. It's a very simple agreement fixing the price of the future transaction. Speculation using, okay, and I think I will stop here. And futures exchanges. Let me try to show you some futures exchanges. Futures, where do you buy? Futures can be traded only in exchanges. Forwards are traded between the parties over the counter, but futures are traded in exchanges. The futures exchanges. Let's look at the futures exchanges. One is commodity exchange. If you want to buy and sell commodity futures, like gold, silver, agricultural commodities, there are national multi-commodity futures exchanges in India. NMCE, MCX, NCDX. These are the three important commodity exchanges. Then specific commodity futures exchanges, International Pepper Futures Exchange, Coffee Futures Exchange. There you can buy and sell only coffee or only pepper. And then financial futures, commodity futures are this. Financial futures are our NSE and BSE. NSE and BSE. There is a separate section called F&O, Futures and Options. Futures and F&O means futures and options. Options are also traded in the stock exchange. Currency futures. There are NSE and BSE you can use. separate currency derivative section is there in NSE, BSE. There is another exchange called USC, United Stock Exchange. That is for currency derivatives only. So these are the futures exchanges where futures are options. I think option will take some time, so I will stop here. At least you have understood two. You understood what is derivatives, what are derivatives. You have also understood out of the three instruments, you have understood two instruments. The two instruments are forwards and futures. Both are the similar, same agreement fixing the future price of a transaction. One is traded over the counter, the other is traded through the exchange. I think we can take questions now. If let me see if I stop the presentation, and if required, I'll come back to the stock sharing. Okay, sir.
Sir, yeah. Should I take up the question, sir?
Yeah.
Sir, one question is from Priyanta Ghosh. Two questions actually she is having. One is a derivative an instrument used for short-term transactions? That is, if I want to make a transaction after 1 year, can I use derivatives to reduce risk?
Risk derivatives are instruments. The maximum duration of a derivative is 3 months.
So this
3
is for
months.
short-term only.
Yeah, 3 months.
Short-term.
Maximum 1 month, 2 months, 3 months.
Okay, second question from same is what is the basic difference between trading and investment?
Okay. So if you take shares, for example,
Okay.
trading is done for investment. Investment requires trading, because investment, if you want to buy a share, you have to, the trading means buying and selling. So investment involves first buying, after 1 or 2 years selling. So trading is the method of, or the way through which we are investing. For investing, we have to buy, later sell. So now there are two types of trading. One is short-term trading, other is long-term trading. Short-term trading means you are buying now and selling only after 3 or 4 years. Long-term trading, sorry. Long-term trading means you're buying a share now and selling only after 2 or 3 months, 2 or 3 years. Short-term trading means, see, I can buy a share in the morning, I can sell it in the evening. I can buy a share today and sell it tomorrow, after or next week. That is short-term trading. That is speculation. Short-term trading is used for speculation. Long-term trading is used for investment. So her question was, what is the what are these two things, investment and trading?
Trading, yeah.
So
Short-term and long-term is.
investment happens through long-term trading. Speculation happens through short-term trading. Okay.
Sir, next question is from Ashok Sharma. He's asking, why are forward derivatives considered more flexible but riskier than future contracts?
Okay. Forwards are risky
Yes.
because the counterparty may default, because it is two parties. No, I am entering into an agreement with a foreign exchange dealer. Supposing I want to buy something, he may default. So there is a default risk is involved in a forward contract. Whereas in a futures contract, there is no default risk, because the counterparty is always the clearinghouse. So comparing forwards and futures, risk, there is no risk in futures, but there is risk in forwards. Risk, which risk? Default risk, or we say credit risk. Now, easy, there was a time when forwards were easy, because you can go to your nearest foreign exchange dealer and sign the agreement. People considered transactions through exchanges, national stock exchanges, difficult. Now it has changed. Now all of us know that trading through the stock exchange, through using the website, is very easy, much easier than going to a foreign exchange dealer. You don't even have to travel anywhere. Sitting at home, you can do the transaction. So now from that angle also, futures are better.
So another question from, sir, you may switch on your camera.
Okay. Wait, one second.
So
Yeah.
next question is from Dr. Ashok Sharma.
Yeah.
He's asking, what is basis risk in future trading and how can it affect hedging strategies? Basis risk.
Understand. Basis. Now, basis means, it's a technical term. Basis means spot price. Supposing you are taking a share or a foreign currency or a share, it has a spot price. And we are fixing a price for a future transaction. That is called the futures price. So there will be a difference between these two. The spot price and the agreed price. In the futures and forwards, we are agreeing a price. So the spot price and the agreed price, there will be a difference, a small difference. And that difference is called basis. The difference is called basis is a technical term. The difference between the agreed price and the spot price is called basis. Now, the lesser the basis, better the hedging because the difference is less, ideally, the futures agreed price should be the same as the spot price. Basis should be zero. Basis should be zero. But so the minimum basis will not be zero. There will be a small difference. There will be a large difference. So for hedging effectiveness, it is always better to have a small basis than a large basis.
The next question is from Surabhi Tika, asking for please explain how swaps work. Swaps.
But no time.
Yeah, it will take time, sir. Yeah.
It will take. It will take.
Next speaker has already joined.
That's right.
So maybe some other future
Yeah.
discussion we can do. And one question is from M. Rajesh, Dr. M. Rajesh.
Yes.
He's asking if we buy equity for long-term price down, how to protect the risk for long term. So this will not work in that case because it is for short term only.
Derivatives are for short term. Long term, basically, we expect the market to move upwards, appreciate. So risk is in the short term. So derivatives are used for short term risk coverage. That's why its duration is 3 months.
Another question is from Adi Vepa. He's asking, is forward contract completed without the stock market account?
Yeah. Forward contract, we don't need any stock market account. It is between the foreigners and dealer and myself.
Buyer
For
and seller.
futures, we require a trading account.
And another question from Amit Kumar Tiwari is how to work call and put prices in future market. And this will again take a long time, sir.
Yeah, that's
Pricing is a different subject.
Options.
So we are unable to take this question in session. If we get some time, so some other we'll discuss.
Definitely.
So that's all about all questions, sir. Thanks for your very in-depth analysis, explanation of this. Now you are telling it is not complicated. We are unaware. That is the thing. So the topic which are much not aware we are.
Yeah.
So thanks for elaborating this, sir. And sir, hopefully we will meet again in some platform and we'll call you again for this. Thank you, sir. Thank you for joining.
Thank you so much. Thank you so much. Thank you to the participants also. Okay. Okay. I may leave with your permission.
Yes, sir.